Hi, everybody. Happy Tax Week. Thank you for tuning into this conversation on tax policy as competition policy, reimagining how the U.S. tax code can foster a more equitable and participatory economy. My name is Suzanne Kahn. I'm the vice president of the think tank at the Roosevelt Institute. The Roosevelt Institute is a think tank, a student network, and also the nonprofit partner to the FDR Presidential Library and Museum. And together, all those different pieces of the Institute learn from the past and work to redefine the future of the American economy. It is now, and we could say once again, widely recognized that when corporations have excessive market power, workers, small businesses, and consumers are hurt, and economic, racial, and political inequality deepens. Federal and state antitrust agencies have begun to reclaim their rightful roles in checking the power of a small number of firms to concentrate control of the economy. But too often, tax policy has been overlooked as an essential tool in leveling the economic playing field. This has not always been the case. Today's roundtable discussion will resurface and explore the anti-monopoly roots of tax policy. Shortly, you'll be hearing from amazing scholars led in conversation by Roosevelt's Director of Corporate Power, Nico Luciani. He will introduce our panelists in a moment, but first, I'm thrilled to kick off with some opening remarks from Senator Elizabeth Warren, who really needs no introduction, but as I think everyone here probably knows, is not only the senior senator from Massachusetts, but a former Harvard law professor and a groundbreaking consumer advocate who has spent her career fighting for big structural change to rebuild the middle class. So without further ado, Senator Warren.
Hello, Roosevelt Institute. So I want to start out by saying thank you for the opportunity to get wonky with you on a very important issue, the tax code. We have seen the impact of market concentration. Families struggle under rising prices, small businesses get squeezed, and companies have the leverage to lower workers' wages, all while corporate profits soar to new records, driving over half of our current inflation. So what does that mean for the tax code? Well, our tax laws have been written not to curb monopoly power, but to subsidize it. Take Donald Trump's 2017 tax cuts. Did they go to help working people? No. They slashed the corporate tax rate by 60%, a $1.3 trillion giveaway that overwhelmingly went to giant corporations. And did that tax break trickle down to working people? Nope. Business investment declined. And when the pandemic hit, big companies used inflation as an excuse to hike prices even further. And thanks to that massive 2017 tax cut, corporations paid less than ever on those giant profits that they made. In other words, we are subsidizing corporate price gouging. Now, that's just not right, and we need to fight back. We've made a good start under the Biden administration, including by enacting my corporate minimum tax, which means billion-dollar corporations like Amazon now have to pay at least 15% of their giant profits in taxes. But there is more to do. From ending a loophole that provides a tax subsidy to mega mergers, to ending tax breaks for giant multinationals that offshore jobs and profits, all of those things, we can build a tax code that rewards competition instead of consolidation so that we can help level the playing field for everyone. So I just want to say thank you for hosting this important discussion and for doing this powerfully important work. I am confident that together we can build an economy that works for everyone.
Thank you, Suzanne, and thank you, Senator Warren. So it's time to get wonky. My name is Nico Luciani. At the Roosevelt Institute here, I direct the Corporate Power Program, which works for a more innovative and participatory economy through structural changes to corporate governance, to antitrust, and to tax policies. In 1938, President Franklin Roosevelt told Congress in his speech specifically on curbing monopolies, quote, "Today's concentration of private power is seriously impairing the economic effectiveness of private enterprise. Tax," Roosevelt said, "has a real value in working against a further concentration of economic power." This idea that tax was an anti-monopoly tool was not new or particularly radical at this time. It was pretty well settled. In fact, as we'll learn in a bit, the very first corporate tax, almost 3 decades prior to this speech, was primarily intended as an antitrust measure. Yet today, taxation remains too often overlooked, both as a driver of current levels of harmful market concentration, as well as a tool to remedy this economic problem. Just take Amazon, maybe the foremost example of a 21st century monopoly distorting fair competition. Until recently, few had connected the dots between Amazon's market domination strategy and its tax strategy. But as Stacy Mitchell and Susan Holmberg found recently in a contribution to our Taxing Monopoly series, the company's market dominance was fueled by lucrative tax advantages largely unavailable to its competitors. The opening salvo for Amazon's tax strategy, you may know, was locating its first headquarters in Washington instead of California, where most of its consumer base was. This tax advantage drove Amazon's growth during its first 2 decades, while precluding the growth of competitors in the then nascent e-commerce and broader retail sectors. Meanwhile, Amazon, like many other multinationals, spent years developing a sprawling network of offshore subsidiaries, which helped the company avoid corporate income taxes in the US by allowing it to transfer profits to low tax jurisdictions like Luxembourg. The European Commission found this to be a form of unlawful state aid, specifically because it violated competition policy by conferring a selective advantage to one company over competitors. The result, Amazon paid just 9% in corporate income tax over the 5 years since the Tax Cuts and Jobs Act went into effect. These and many other tax advantages over the years netted Amazon billions of dollars and gave it a major advantage over smaller domestic businesses that shoulder more of their tax obligations. These policies provided a crucial source of dry powder as well for Amazon's killer acquisitions and predatory pricing schemes, enabling the company to sell below cost to capsize competitors and to lock in online shoppers. Unfortunately, Amazon's tax-fueled rise to market dominance is not an outlier, but an example of a broader structural defect buried in our federal and state tax codes. Last year, we at Roosevelt launched the Taxing Monopoly series, which is aimed to explore the anti-monopoly roots of the corporate tax and uplift concrete ways to reform the tax code, as was said by Senator Warren, to benefit competition, not consolidation. This series joins a small but growing movement of scholars and advocates unearthing how the tax code encourages monopoly harms and how tax policy's regulatory function can be taken seriously again. Jeremy Barra-Friend, Stephen Bank, Kitty Richards, Stacy Mitchell and Susan Holmberg, Ignacio Gonzalez, Edward Fox, and Zachary Lisko, Kimberly Clausing, Reuven Avillona, and Sandy Hager have all pushed the envelope of our understanding of the relationships between tax and market power. You're in for a real treat this afternoon because I'm very happy to be able to introduce 3 real luminaries in this growing field around tax and market power. And I'll be moderating today's conversation with Professors Kimberly Clausing, Reuven Avillona, and Sandy Hager. They'll be discussing their latest research on how the US tax code affects market concentration and how to reform the tax code in a way that levels the economic playing field. Now, we'll have time for a Q&A at the end. I'm going to be a strict moderator and make sure that everyone can participate. So feel free to plug in your questions at your convenience in the Q&A box below here on Zoom. So we're going to start with Professor Clausing. Kim is the Eric Zolt Chair of Tax Law and Policy at UCLA Law School, and I'm a proud alum. Her research studies the taxation of multinational firms. Many of you know during the first part of the Biden administration, Kim was the Deputy Assistant Secretary for Tax Analysis at Treasury, serving as the lead economist in the Office of Tax Policy. And we're very lucky her latest article, Capital Taxation and Market Power, is coming out in the tax law review and was just released this week as an issue brief with the Washington Center for Equitable Growth. And it does a really fantastic job of exploring the various ways the tax code affects market power. So Kim, why don't you get us kicked off here by sharing some thoughts about why, as an economist, market power matters and how the tax code today contributes to it.
Great. Thanks so much for that introduction and for inviting me to be part of this conversation. I'm just going to get my slides up here, which hopefully you can all see. So as Nico pointed out, this is an overview of recent work that I've done on capital taxation and market power. And I think for those in this audience, you're probably already aware that market power has been increasing a lot in the US economy and really worldwide. And this can be seen with any number of metrics, including those listed right here. This chart shows the rise in markups or price relative to marginal costs that we've seen both globally and particularly strongly in North America. And because of this rising market power and concentration across a broad swath of industries, there are a lot of negative consequences that we might worry about. Two that I think are particularly salient are what it does to the labor share of income and income inequality more generally. But another important consideration is what it does to capitalism itself. When competition is too concentrated, the flow of resources and the efficient outcomes that we might expect from capitalism tend to be less efficient. So that's an important element as well. When we turn to the tax code, we're used to thinking about national income as being part labor income and part capital income, but it's also particularly useful to realize that capital income comes in two parts. So sort of a normal return to capital, which is just the standard reward that people get for deferring consumption, but also this excess return or above normal return to capital. And that can come from market power and firms deliberately dominating markets, but it can also come in a more transitory way from luck or being the first to arrive at a market opportunity or an unusual market condition. But regardless of what generates these excess profits, they can be a relatively efficient part of the tax base. And recent empirical work, and I've got 3 papers that I review in more detail in my work, has shown that the US corporate tax base is mostly comprised of these above normal excess returns to profit. And with redesign, it could be even more closely correlated. What that means is that the corporate tax can be more efficient than almost any tax we have in our tax system, because the same decisions that firms make to maximize their before tax profit will maximize their after tax profit. So they have no reason to distort their investment or labor or economic activity in response to this tax. It also means that the more we're taxing these excess rents, the more the incidence is likely to fall on shareholders rather than workers or investment. We might worry that if we were burdening regular investment, that could reduce the capital that workers have to work with. But if we're taxing these above normal profits, we don't have such great worries. This also means that the tax system is an important tool to counter market power. And we already have a lot of good reasons for having the corporate layer of taxation. Capital income goes entirely untaxed, about 70% of US equity income, because it's in the hands of foreigners or nonprofits or retirement accounts or other vehicles that avoid taxation. But in addition, even the 30% that is taxed often benefits from features like deferral and step up in basis at death. So really, if we want to tax capital income holistically, we have to start at the business entity level. But another good reason for taxing at the entity level is it gives us another tool to affect corporate behavior. For instance, if we want to encourage clean energy, we can give a clean energy tax credit. But in this context, if we want to reduce market power, we can have higher tax rates for firms that have particularly large market dominance. And that would be an important way to counter market power in our economy. And so in this paper, I suggest that we should consider having a graduated corporate income tax, not for the standard reason that we have graduated income tax rates, but effectively as an antitrust nudge, or as a continuous way to encourage the economy to be more competitive. So just as one illustration, let's say you did these marginal tax rates that I suggest here. This would actually leave more than 99% of C Corps unaffected. They would have the current tax rate. But the rate would go up on a marginal basis as they earned more profit, so that for the largest firms, those earning over 10 billion, which is just a few dozen firms right now, they would face the old pre-Tax Cuts and Jobs Act corporate tax rate of 35% on their marginal dollars. And then rates between the current rate and the 35% rate would apply to intermediate levels of income. If you look at the distribution of corporate taxpayers, you see that almost none of them would face these higher rates. The light blue bars are showing you that almost every C Corp, there's about 500,000 of them, has much lower profits than what would trigger higher tax rates under this plan. But the vast majority of the tax base is in fewer than 2,000 firms, which account for almost 90% of the tax base. And so you can affect almost all of the tax base, but very few of the taxpayers with this type of reform. And this is just a tabular version of the picture you just saw, which you could always download the paper. It's on SSRN, or the short one is Equitable Growth. When I look at this, the consequences of doing these possible graduated rates, again, very few taxpayers would pay it, but it could raise as much as $65 billion a year. Now, that's absent behavioral response, and there would be some behavioral response. Some of this is actually by design. If companies decide to not merge or not become larger because they don't want to pay the additional marginal tax, that's part of the goal here. That's a feature, not a bug. But to the extent that there was artificial separation of companies without true division of management and control, that you could use rules to kind of overcome that type of responsiveness. The biggest type that I would worry about, though, is the incentive to shift profit offshore, particularly because big companies are particularly agile and good at moving their profits offshore. So it's very important to pair this kind of reform with something that can really tackle international tax avoidance. The good news here is that most of the rest of the world is moving towards a global minimum tax that would tax these big companies at least 15%, no matter where they earn their income. And so that gives the United States more space to toughen our international tax regime, particularly with respect to these larger firms. And those are the ones that are most likely to shift income offshore. So this international tax agreement kind of lays the groundwork for what we need to do to protect the tax base, but we do need to pair graduated rates with international tax reform. One final thing, and then I'll close, is that while I think corporate tax is the easiest way to get to the vast majority of capital income in the United States and to fully tax it, I do think there's room for individual capital gains tax reform too, and I'd be happy to discuss that in the Q&A. And I also think, I believe Reuven is discussing this in more detail, but I also think it's useful for us to look at approaches like Senator Whitehouse's bill recently with Senator Vance that would end most tax-free mergers in the case where the combined average annual gross receipts exceed 500 million. That's another way to change our tax code to avoid rewarding agglomeration and excess power. And I think we should be looking wherever we can to find ways to make our economy more competitive and fair. Thanks.
Thanks so much, Kim. That was really a great introduction in terms of the basic economics of dealing with market power through the tax code, and how actually, thinking of disaggregating normal rents from super normal rents or above normal rents is really essential for this broader problem. And there's so many economic assumptions that are based on the idea that all profits are equal. Here, really understanding that above normal rent seeking, above normal profits are actually inefficient, I think really helps us to understand why a flat corporate income tax rate may not be the best way forward. So with this, I really want to move on to Dr. Sandy Hager. Sandy is a political economist in the Department of International Politics at City University of London and a fellow at the Commonwealth think tank. His book, Public Debt, Inequality, and Power: The Making of a Modern Debt State, was the first comprehensive historic analysis of public debt ownership in the United States. Hager recently co-authored with Dr. Joseph Baines a great contribution to our Taxing Monopoly series. Does the US tax code encourage market concentration? An empirical analysis of the effect of the corporate tax structure on profit shares and shareholder payouts. So Sandy, I think Kim did a great job of understanding a little bit the nuts and bolts of this issue. I think you really zoom out and look at a much broader macro picture. I'd love you to share with us some of the key findings from your empirical analysis on the anti-competitive effects of the US tax code over time.
Sure. Thanks, Nico, and thanks to you for organizing this wonderful event. I'm just going to bring up my slides here. All right. Yeah, so thanks very much, Nico. I don't have a lot of time, so I'm just going to jump into things. In my presentation today, I want to do, as Nico suggests, and walk you through some of the main findings from a brief that I co-authored with my friend and colleague Joseph Baines on corporate concentration and corporate tax. And we published this research brief with the Roosevelt Institute near the end of last year. And basically, what we show in this brief is that the tax system does play a vital role in encouraging monopoly power. And what we also show is that this has a number of dire consequences. So tax-fueled monopoly not only stifles economic dynamism, but it also contributes to rising household and racial inequality. And here is just a screenshot from the Roosevelt Institute website where you can find our brief if you're interested in learning more, because time is of the essence and I can't go through everything in detail. So in our research, what we're trying to do is examine the relationship between corporate tax and corporate concentration, and we're focusing on publicly listed non-financial corporations that are headquartered in the United States. And our research really starts with just a basic question. Does big business in the United States enjoy some sort of tax advantage? And in the brief, we tackle this question by looking at the pre-tax and the post-tax profit shares of large corporations. So what that means is we look at the share of total profits received by large corporations before they're taxed, and we compare that to the share of total profits received by large corporations after they're taxed. And that means that if the pre-tax share of profits is lower than the post-tax share, then the tax system is playing some sort of role in reducing concentration. And if the pre-tax share of profits is lower than the post-tax share, that means that the tax system is playing some sort of role in increasing concentration. And here we have figure 1 from our brief, where we look at the effects of the overall tax system on the distribution of profits. And if we look at it historically, we can see in the 1970s up until the mid-1980s, the pre-tax profit share of large corporations was larger than their post-tax share. This obviously means, again, that the tax system is reducing concentration. But then we see a shift from the mid-1980s onward. After that point, the pre-tax profit share of large corporations becomes consistently smaller than their post-tax share. And again, this suggests that the tax system is playing a role in increasing corporate concentration. Now, the next step in our research was to break down the overall tax system into its domestic and its foreign components. So in figure 2, we focus on the domestic tax system. So that would include both the federal and state level taxes. And here we see that the domestic tax system has increased domestic profit concentration since the mid-1980s. And the effect is actually quite significant. If we look at the most recent period from 2019 to 2022, we can see that the tax system, the domestic tax system, has increased the profit share of large corporations by 3.79 percentage points. We then move on to look at the effects of the foreign tax system in figure 3. Here, the picture is a bit more mixed. In some years, the foreign tax system increases the foreign profit share of large US corporations. In other years, it reduces it. We found this quite surprising, the data here. Normally, when we think about the tax advantage of big business, we imagine sort of large corporations stuffing their profits in foreign tax havens to try to avoid domestic taxes. That's certainly part of the story, and we're not trying to deny the importance of the international context. But what our research shows is that we do have to pay a lot of attention to the domestic situation, to the domestic tax system, and the way that it's fueling corporate concentration. Now, the next question we tackle in the brief is, why does all of this matter? You know, who cares if big business has enjoyed this decades-long tax advantage? For some people, lower taxes are always a good thing, no matter who's receiving them. And according to this argument, you know, if large corporations are enjoying a tax advantage, then no problem. That means they're going to use their tax savings to invest and create jobs and higher wages for workers. But as we show in figure 5 here, this argument doesn't correspond with reality. Here, what we're doing is we're looking at the capital expenditures of large versus smaller corporations as a percentage of their total revenues. And what we show is that the capital expenditures of large corporations have actually fallen rather than increased in line with their tax advantage. So again, in the 1970s to the mid 1980s, the capital expenditures of large and small corporations were roughly equal. But then with their tax advantage from the mid-1980s onwards, we see a dramatic drop in the investment of large corporations relative to smaller ones. And this leads to another question that we address in the brief. You know, if large corporations aren't responding to this tax advantage by increasing their investment, then what exactly are they doing with these tax savings? Well, as we show in figure 6, what large corporations are doing is, with these tax savings, is enriching their shareholders. They're enriching their shareholders through increased dividend payments and stock buybacks. And as we see in the figure, you know, the shareholder payouts of all corporations in our sample, whether they're large or small, they've been increasing over time. But it's important to note that the shareholder payouts of large corporations are consistently higher than those of smaller corporations. And this leads us to one final question that I want to address here before concluding. That question is, who benefits from these increasing shareholder payouts? It's important to stress that in the United States, share ownership is highly unequal. In the brief, we cite data from the Federal Reserve, which shows that 89% of corporate equities and mutual fund shares are owned by the wealthiest 10% of Americans. And the same data from the Fed show that white Americans own 90% of corporate equities and mutual fund shares, whereas Black and Hispanic Americans own 1.1 and 0.5% of those corporate equities and mutual fund shares, respectively. So what we see here is a really troubling dynamic. Our research suggests that the corporate tax system is not only fueling monopoly power, but it's also contributing to rising household and racial inequality. We think that this is something that needs to be addressed urgently, and I'm sure that's something we can discuss a little later on in the Q&A. So I'll end things there and hand it back to Nico.
Thanks so much, Sandy. That was really astounding. And, you know, I think one of the interesting things, in addition to what Sandy was saying, is, you know, looking at the US economy today of publicly listed corporations, we have data for something like 95% of the profits overall within that section are captured by just the top 10% of firms. And as Sandy shows in his brief, you would think that the more profitable the firm, the more they would spend in capital expenditure as a percentage of their revenue, but actually he shows the opposite, that the most profitable firms for some reason are spending less on capital expenditure, which again gets into these questions of what is the investment results of treating high profits at the same rate as other profits. So I'm very excited now to move to Professor Reuven Aviona, who is the Irwin I. Cohn Professor of Law and Director of the International Tax LLM program at the University of Michigan. He specializes in corporate and international taxation and has served as a consultant to the U.S. Department of Treasury and the OECD on tax competition. He's a regular columnist at Tax Notes and has published more than 250 books and articles, including maybe more, maybe less, maybe more probably now by now. relevant to this particular topic, he recently published 2 articles, Antitrust and the Corporate Tax, 1909 to 1928, and A New Corporate Tax, both of which explore the historic and contemporary linkages between competition and tax policy. I think a lot of people know and love Professor Avellona for his tax law expertise. Some people don't know that he actually has a doctorate in history as well. So Reuven, I would love it if you could kind of round us off by taking us back a little bit to the roots of the corporate tax. What was it for originally? And then discuss, as we transition into looking forward, some potential for reforming the U.S. corporate tax code so that it no longer subsidizes market power. So Reuven,
Thank
over
you
to
very much. It's a real pleasure to be here and to discuss these topics with you. Let me just share my screen. Right. So basically, what I want to show you is a little bit about the origins of the corporate tax in the United States, and then talk a little bit more about Kim's progressive tax rate proposal and its implications, and then talk a little bit about the newly proposed legislation that Kim also mentioned about involving corporate mergers. So here is President Taft's original message for the Corporate Tax Act of 1909, which is when our corporate tax was adopted. And the rate that was enacted back then is 1%. So it wasn't a revenue measure. It was about curbing monopoly and antitrust. And this was at the height of the first great effort to apply the Sherman Act and the Clayton Act later to large monopolies. In 1911, Standard Oil was broken up as a result of a Supreme Court decision. And this was kind of part of that effort. And the point was primarily to get the government information, because back then with no corporate tax, they basically had no idea, and no SEC and no public financials. They had no idea what was going on. So the idea was, let's enact a corporate tax, and then we will know what corporations are actually doing. So the key element in the message is to say, if now by a perfectly legitimate, effective system of taxation, we're incidentally able to possess the government and the stockholders and the public, because it was the tax returns were to be made public, of the knowledge of the real business transaction and the gains and profits of every corporation in the country, we have made a long step towards the supervisory control of corporations, which may prefer the further abuse of power. And then this was a comment on it that was made on the floor by Senator Cummings of Iowa, who was a Republican, progressive Republican. And his complaint was, okay, but if you're going to do that, why apply a corporate tax to all corporations? We should rather focus on the largest corporations. And he says, if we can regulate a corporation simply to the medium of taxation, we can destroy every trust in a fortnight, because his idea, of course, was have a much higher rate than 1% on the large corporations, which is exactly the corporate tax, the progressive corporate tax idea. This was actually implemented by President Roosevelt in the 1930s as a result of the message that Nico mentioned earlier. And we've had a progressive corporate tax since then until 2017, when the tax in the TCJA was made flat at 21%, as well as the massive cut that was mentioned earlier. But the problem was that they never updated the thresholds. So by 2017, almost no corporations pay the low rate. Everybody was basically paying the flat rate, with a lot of loopholes, the 35%, and now we have a 21% flat rate. And the idea was basically to go back to the progressive tax and have a significantly higher progression. Kim's proposal is to tax the really top corporation above $10 billion in profits at 35%. I should just mention that historically we've had much higher rates than that even. 53.6% was the top for the regular corporate tax, but for the wartime World War I and World War II excess profit tax, the top rate was 80%. So you can imagine even higher rates than that. And the point is that 2 points. One is, to the extent that we really believe that the profit of these largest corporations are above normal return or rents, and that they are quasi-monopolies, well, then there's no efficiency downside to taxing them at even higher rate, for the simple reason that they're since they don't have competition, their behavior will not be affected. They're going to do the same thing even if they pay tax at a higher rate, because they still will have pure profits that inure to the benefit of the shareholders. So that's, and in addition, if you just look at it from a kind of competitiveness perspective, the reality is that if you look at the top corporations in the world now, 9 out of the top 10 are American. The usual names. The only exception is Saudi Aramco, but everybody else is, Amazon and Google and Meta and Nvidia now, and so on and so forth. And they all have profits above $10 billion. So you can imagine even higher rates than that. Two really important things, though, to pay attention to. One is simply to say that we need to do this on a global basis, and we need to make sure that inversions are stopped if we raise the corporate rate. So just on the global basis business, the CAMT, the Corporate Alternative Minimum Tax that was introduced in the Inflation Reduction Act as a result of the efforts of Senator Warren, applies for the first time ever on a global basis with a single rate. And that's what we should do. And then we should also adopt a proposal that, for example, Senator Sanders has recently introduced to stop inversions by changing the thresholds and making sure that every corporation that's managed and controlled from the United States is taxed as a domestic corporation. Finally, let me just say a word about the White House Vance Stop Corporate Mergers bill. This is an article from 1957 suggesting exactly the same thing, to stop subsidizing large mergers. In view of the risk of oligopoly and increased concentration of business and the importance of preserving the separate existence of smaller businesses, it would appear to be sound governmental policy to eliminate this tax incentive to such mergers and to leave the tax law neutral in this area. Neutral in the sense that the usual tax results of sales exchanges, namely taxable under the code, will attach to such mergers. And one important point is that when a large public corporation buys another large corporation, that frequently or most commonly is for cash. And even if it's not, it doesn't make that much of a difference because, as was mentioned, 70% of equities are held by tax exempts or foreigners. It's really the large corporation buying the startups that is buying up their competition that is the key here. And that is basically what we most worry about when we think about corporate acquisitions and monopolization. Thank you very much.
Thanks very much, Reuven. So we're going to move now to the questions. There's a lot of them, and I think as we look forward now to the sunsetting of many of the provisions of the Tax Cuts and Jobs Act, I think it's a really live moment to talk about what our tax code is for and what are some concrete ways that we can turn this tax code around so it favors fair competition over consolidation. Maybe we can start with a sort of a packet of questions around this proposal of moving back to a graduated corporate income tax rate. As Reuven and Kim have said, this was the case for many, many years that we had a semi-graduated rate. The flat rate went into effect in 2017. What does it mean to move back to a graduated rate? So I'm going to ask a couple of questions and then turn it over to the panelists to think through those questions with us. I'm going to go backwards from the order of how we began. So on the graduated corporate income tax rate, one question I had, just taking advantage of my moderator position, is, thinking of this also as a moment around industrial policy and the need to rebuild our industrial base, how might a graduated corporate income tax rate actually incentivize the types of investment that is needed in the country? The issue of international mobility as a challenge here was brought up by Reuven and Kim. I'm wondering if you could dig in a little bit more in terms of what are those challenges and what we could do to change them. And then one person asks, what is the best argument or evidence that having a higher corporate tax rate won't be passed on to consumers? Kim, I think you mentioned this briefly. Why would a graduated rate mean that the incidence would fall more to shareholders as opposed to consumers. So I think we'll go backwards. Maybe Ruben, we could start with you, and then go to Sandy, and then end with Kim for this round.
But just one point about your first question. If you want, I mean, a major reason why we have a corporate tax is to incentivize corporation to do various things by granting them lower taxes for the stuff that we like them to do, like creating jobs, for example, or making investments. Essentially, in order to have an effective incentive, you have to have a higher rate. Because currently, for example, if you grant a deduction, it's only worth 21 cents on the dollar. And even if you give credits, which is $1 for $1, if you have a really low effective corporate tax rate before the credits, you don't, and as long as the credits are not refundable, you really don't get the benefit of the credit very much. As the more the rate goes up, the more effective your incentives are going to be. For example, I've written a paper that suggests that we should really encourage investment in places in the country on a location basis that are currently underdeveloped. And one way of doing that is to encourage corporations to create jobs in those areas by, for example, a wage credit of some sort, or even a lower corporate tax rate to the extent that geographically they locate in these areas. Some of the incentives in the Inflation Reduction Act, the green credits, have been designed in order to encourage investment in, for example, so-called energy communities, which is basically fossil fuel places that have been, gone out of commission. And so I think that that's one important reason to have a higher corporate tax rate, is that it makes your incentive structure much more efficient.
Thanks, Kim. Sorry, Sandy?
Yeah, sure. I'll just say generally, I mean, in response to the question of the desirability of graduated corporate income tax rates, you mentioned industrial policy, Nico. I think that's an interesting link to make. If we think about what is the response of large corporations going to be to a graduated income tax, I think there are two common responses. One will be the issue of capital flight, that they'll threaten to move operations abroad. And I think that's why global coordination is so important. I think Kim spoke to that in her presentation. And it would be nice to see some more US leadership, particularly on that front. The other response to a graduated corporate income tax rate would just be the classic investment strike, to say that we're not going to invest as much in productive capacity. Well, at least in the data that I showed from our brief, it's hard to take that kind of argument seriously when we see that large corporations are investing less and less in productive capacity, even with a tax advantage. And I think that threat is still credible. And one of the ways around that is to have some sort of robust industrial policy where the government could take proceeds from tax revenue and actually channel it into those sectors that are dynamic, or creating jobs, and helping us to combat the climate crisis. So graduated income tax on its own probably needs to be combined with these other things for a more holistic response.
Excellent. Thanks, Sandy. Kim?
Yeah, so on international mobility, which I think is a really crucial point, I think we should pursue two approaches to that. One is more leadership and coordination. I think the Biden administration has been good at this. I think Congress needs to also see at times that with international collective action problems, we do better for ourselves when we work together with partners. And that's true in this space, but it's also true in other spaces. But even absent international coordination, I think it's important that the United States remember that we do have an enormous advantage associated with being the United States. So if you think about the companies that are at the very top in terms of size and market power, this might be 50 companies, this might be 100 companies, it might be 300 companies, depending on where you draw these lines. But certainly for the top 50 or so, which is a larger number than would be in my top bracket in that example, there's room to give them special international tax rules, right? You could have them pay on a consolidated basis, allowing foreign tax credits. That could work really well. The argument against is, well, they won't be competitive when facing competitors abroad that have better regimes. But remember, these are the companies that we have the least competitiveness concerns about, right? They're already dominant. They don't need to fear being displaced by some smaller foreign firm. On your question about passing through to prices, I think it's important to remember that it's a profit tax base, right? So if it were a sales tax base, I think we'd have to worry about that more. But for a profits tax base, the company is already making the decisions that maximize their pre-tax profits. If we come and take a little bit of that profit, that's not going to change those optimal decision patterns. So even economists that are on the right side of the spectrum agree that this tax does not get passed on to consumers through higher prices. They might have disagreements about other claims that I'm making today, but not that one. And then finally, on the investment effects, I completely agree with Reuven that this is a way that we encourage companies to do certain things. And sometimes there are things that we want companies to do to respond to market failures, like invest more in clean energy and the like. And I think part of why we don't see more robust investment performance in the US is in part because of market power. If you look at the macro models or the micro models, like when you've got a lot of market power, you don't have as big of an incentive to invest in the next thing. With respect to industrial policy, I think I'd be a little wary about taking the proceeds from a tax and funneling it back into industries that the government deems to be vibrant. I would want to look for a clear market failure. I don't think handing companies money is the quickest way to job creation. I think we have a lot of jobs in the United States already. We're at full employment. So we need to think about where the best use of that public finance is. And I would argue that investments in people, early childhood education and the like is a better, kind of bang for your buck than just throwing it at dynamic industries. But there are industries where we have legitimate market failures, and I think the green transition industries are certainly one. And that's an area where I would say that we need resources to help solve the climate change problem. And there's other places to get resources too, but I think this is a really efficient tax.
Great, thanks so much. Reuven, you really went into the question of how the tax code creates this loophole for large mergers, and mentioned Senator Whitehouse and Senator Vance's new bill. Just to give a little bit of context there, some of the biggest deals which we look back on now as particularly harmful that are subject to some antitrust suits include the Facebook acquisition of WhatsApp, which was an all-cash deal, which likely used this particular form of restructuring. Two recent big oil deals, Chevron's acquisition of Hess and ExxonMobil's acquisition of Pioneer, were both all-stock deals, which essentially allowed any capital gains tax to be deferred potentially indefinitely. I'm wondering if there are, any counter arguments to the idea of ending this particular subsidy to large mergers that you'd like to bring up, and maybe some ways to ameliorate those.
So the standard line is it's just a mere change of form. That is, there's nothing that happens. There's a reshuffling of paper basically at the corporate level, and that has been the defense of. By the way, the original corporate tax did not have M&A. This came in 1921 after the Republicans. No, actually 1919 after the Republicans took over Congress, and that was the original M&A, and we've had it ever since then. But the reality is that when you have, in particular, a large public corporation acquiring a small privately held corporations, and your examples are that basically, that's not a mere change of form. You're changing shares in the corporation that you control that are not publicly traded for shares in the corporation that you don't control and that are publicly traded. It's a completely different form of investment. It's definitely not a mere change of form. Another argument is that there's neutrality. That is, that taxes should not influence the decision of business to merge or not to merge. But that's simply, the standard is taxable. It's a realization event. There's no reason not to have a tax. If we're going to, it's officially labeled a tax expenditure. If we're going to give it tax-free treatment, there has to be a good reason, like Kim mentioned, a market failure of some sort. It's hard to see a market failure argument for this kind of treatment. And as I mentioned before, if you have a large corporation, public corporation buying another public corporation where you can maybe argue that it's a mere change of form, I don't think so, because otherwise, why would they merge? If it's the same corporation. But in those cases, frequently I mean, there really is a choice between cash and non-cash, because a lot of shareholders, and even the shareholders that are taxable, typically sell it to arbitrageurs for cash before the merger, and then the arbitrageurs send it in the merger, in which case cash and stock is the same, because there's not a lot of bump up in, there's not a lot of gain involved. So all of these mergers will probably not be affected too much. The ones that will be affected are the ones that we're worried about, namely the large corporation buying the competitor, the WhatsApp acquisition, the Netscape acquisition. All of these things were designed essentially to eliminate any competition in these areas.
Great, thanks. So there's some questions around state level policies. Sandy, you in your paper you were able to disaggregate sort of the effect, the competitive effect of state, federal, and international. And so maybe we could dig in a little bit now that we've discussed some elements of the federal tax code, and maybe answer this question from Tiffany Maloney. What policies could be undertaken at the state level, either legislatively or through the AG's office or other administrative measures? This is really for anyone who'd like to answer this question. And kind of relatedly to that, is this problem of tax and market power only related to multinational companies, or are some of these recommendations apply to domestic companies? Michelle Sternhall asks, to what extent are some of these recommendations, how could they impact the health sector, where there's rampant consolidation among hospitals, as well as vertical concentration by insurance companies, which are really affecting not only the price of essential medical services, but also their quality. So maybe Sandy, I'll start with you, and then over to Kim, and then Reuven, if you have any thoughts as well.
Yeah, sure. So I guess in terms of the data that we compiled, looking at the effect of, or the role of state tax and all of this, it's difficult to tell with the data that we're using, because it looks at just at domestic taxes. There's obviously not an accounting entry for state level income that would allow us to look at the effective tax rate or the profit share at the state level. What we find is that state taxes also play a role in redistributing income to large corporations. They're quite a small component, though, if you compare it to federal taxes. That's really where we see the effect coming in. In terms of what can be done, I'm not too sure. This is sort of falls outside of my expertise, but as far as I know, in the US, you do get a lot of states setting themselves up almost as in the same way that offshore tax havens do. I think you've got a lot of issue with tax competition at the state level, and so trying to clamp down on a lot of that would probably help to control this issue.
Thanks, Sandy. Kim?
So yes, with respect to US states, I agree that there's really fierce competition. It's not all in tax. Some of it is in the subsidy space. And it's something that I think we could use more state coordination, just like we have international coordination on this front. There are things that US states can do. Many of them have already adopted a sales-based formula. So requiring combined reporting and making that net as secure as possible, I think, can help them with revenue. But fundamentally, they need the US government to solve some of these problems, because many of them work from the US tax base as the starting point. Although there's moves to have a more worldwide reach there as well. With respect to domestic firms versus multinationals, I think to some extent domestic firms are easier because they don't have as much of a threat to profit shift and respond to higher tax rates. I do think many of them do also have market power, and I think tax here can be used as a very effective nudge. And in fact, I think it's easier because you don't have to worry about them, simply moving things offshore. So, I'm somewhat more optimistic about that. And I do think it's not enough to target multinational companies. You need to target the domestics as well. But we typically do that anyway through our tax code. The multinationals are the ones that can kind of are allowed and encouraged through U.S. tax law to get a 50% or greater discount for operating abroad, whereas the domestics don't have that feature. So it makes that problem easier.
I
Great.
should mention a couple of huge advantages the states have in this regard. They're not bound by our tax treaties. They're not bound by the international standards for allocating profits between jurisdictions. The US Supreme Court has twice approved the constitutionality of worldwide combined reporting. They really should be doing that above anything else, because that really eliminates the profit shifting. And it even deals with the domestic tax haven. If you have kind of a kickback rule that if income is allocated based on the formula to a no tax state, it gets kicked back into the pool of profits that can be allocated based on the formula. So I think those are immense advantages the states have that the federal government at the moment is somewhat constrained by.
Excellent. And just one last question. The Inflation Reduction Act, amongst other things, really boosted the funding for the Internal Revenue Service. And there have been consistent debates in Congress about this question. I'd be interested from you, Kim, and Reuven, what you think about how increasing IRS funding could actually help create a more competitive economy.
I think this is extremely important. I think part of the problem of depleting the IRS over the prior decade, prior to this more recent years and the funding from the Inflation Reduction Act, was that they had the kind of money that they needed to audit EITC recipients at the bottom of the income distribution who may or may not have been filling out their forms correctly, because that's a very simple thing to check. Like, you don't need a lot of training to do that. But to tackle something like partnership income or the tax shenanigans of highly complicated and very well-advised multinational companies, you need much more resources and sophistication. So I think this is part of building a fairer tax system, and I think it will ultimately benefit the typical American to close some of the tax gap that happens when both companies and rich people avoid too many taxes because they can't be scrutinized by an underfunded IRS. So everyone else can have lower tax rates or higher government services when we collect the tax that is due.
And I should just mention that some of the things that they've been doing with this excess fund is things like collect taxes from returns that have actually been filed, except that the tax has not been paid, like really low-hanging fruit, or effectively implement the information that is obtained from the FATCA Act about Americans hiding money overseas to actually collect that money. We already know this, and they just didn't have the resources to do this, and these are typically very rich people, and it's tax evasion that should really not be controversial.
Absolutely. So we're ending here on with just a minute left, and I just really wanted to thank all of you, Kim, Reuven, Sandy, Senator Warren, Suzanne, everyone for participating and asking excellent questions. I think today we've learned a lot about the various aspects of how our tax code is exacerbating harmful market concentration. In the end, tax is not just about distributing money, it's also about distributing power, in this case, power to decide how markets move and how prices are made or taken, how rules are made. We've also seen, with the reflecting on history, that a monopoly blind tax policy is it's not natural, it's not necessary. There has been for several decades a real emphasis on the regulatory role of the tax code. And, as we debate the future of the tax system post TCJA, there are concrete measures which our panelists have brought forward. It's not rocket science. A lot of these things are pretty easy to fix if we have the political will to do so. And I think across a political spectrum, there is a deep concern with domination and consolidation. And, we've discussed today some very concrete ways to fix it, to benefit innovation and participation. So thanks so much to all of you again. Check out our panelists' work as this field evolves, and don't be afraid to check out the Roosevelt website also for more tax work. So bye for now, and thanks again.